What is the reason behind the rapid growth of the crypto ecosystem? Greed and hype? But that is also true for the capital markets. Then why the growth of capital markets has been choppy in many countries? Take India, where less than 5% of the population is in capital markets, but around 7% of the population is already investing in crypto assets. Then it is not really risk aversion that held Indians back from the capital markets. Then what is it? For small investors, investing in capital markets may not be that straightforward. They have to open and maintain various accounts with various intermediaries, which can be expensive. They have to go through the hoops of KYC and various documentation. And as we saw in GameStop Robinhood fiasco, these intermediaries may not always have investors' best interest in their minds. Investing in crypto assets is relatively straightforward. It is not that tightly regulated and also may not need any documentation. Investing can be completely decentralized without going through any intermediary. And with tokenization, investors can get exposure to any asset class. So let's talk about tokenization. We will be talking about the workings of the Mirror platform, which gives exposure to various stocks including Apple, Google, Amazon, Netflix, etc., along with other assets, including some other crypto assets. But tokenization is not limited to stocks only. Theoretically, tokenization can give exposure to any asset. But at the same time, tokenization is not the complete alternative to owning an asset. There are benefits of tokenization and also limitations of tokenization. So let's talk about these benefits and these limitations. Let us talk about the problems with investing currently and how tokenization can solve them. Let's start with geographic restrictions. If you are a resident of another country other than US, you may not be able to get exposure to US stocks, say Amazon, Google, or Netflix. Now, with tokenization, there is no geographic restriction because it is on the blockchain, an open blockchain. The second problem is KYC requirements. Now, many investors who want exposure on various assets may not have the documentation required for KYC or Know Your Customer. With tokenization, these investors can get exposure to those assets without going through the KYC process. A major problem with investing currently is the requirement of opening various accounts with various intermediaries. A trading account, a demat account, and this account and that account, which can be really expensive and taxing. Now, with tokenization, there is no requirement of opening any account with any intermediary. Because most of these tokenization platforms are decentralized, there is no requirement to deal with any intermediary at all. In traditional investing, dealing with various intermediaries increases the cost of investing in form of various transaction fee, management fee, or other kinds of fees. As there are no intermediaries to deal with in case of tokenization, the cost of investing is lower. Now, there is one interesting problem that tokenization can solve, and that is fractional investing. Say you want exposure in the stock of Berkshire Hathaway. Now, the share price of Berkshire Hathaway currently is $435,000. You cannot even buy one stock. How can you get exposure? Tokenization can help with that. Now, there is another aspect to it. You want exposure to Berkshire Hathaway, but you do not want Berkshire Hathaway to be a major portion of your portfolio. Now, as tokenization helps with fractional investing, you can have exposure to Berkshire Hathaway, but to the limited share of your portfolio you want. Another benefit of fractional investing with tokenization is the ability to invest in various illiquid assets such as real estate or private equity. As mentioned before, synthetic assets or tokenized assets are not 100% replacement for owning an asset. Tokenized assets only give you exposure to that asset, no ownership. When you buy a share of a company, you become part owner of the company or member of the company, and there are various rights associated with that. With synthetic assets, you do not get those rights. Another economic issue is that for synthetic assets, you get only capital gains, no dividend or other kinds of returns. Now, another issue with synthetic assets is lack of regulation. Yes, regulation creates boundaries, creates problems, creates complications. But at the same time, regulations give safety nets. And the investors should be aware of that without regulation, there can be extra risk associated with synthetic assets. Synthetic assets may face liquidity issues, as the markets for synthetic assets are different than the markets for the real assets. So the liquidity for synthetic Amazon stock is not equal to the liquidity of real Amazon stock. Now, liquidity issues may influence the transaction speed and the volume of the transaction these markets can process. Now, one thing that investors should be aware of is that there can be a price difference between the real asset price and the synthetic asset price. There are two factors behind it. One, the lag in the Oracle feed data. Oracle feeds are the mechanisms through which blockchains receive off-chain data, and depending on how quickly or how frequently the Oracle feed data is refreshed, there can be a price deviation. The second factor is that for decentralized systems, as there are no central authority to change the token price, the synthetic asset price, there are different kinds of mechanisms that create arbitrage, and the price of the token is changed due to the arbitrage and not automatically. And that process of arbitrage trading can take some time. And due to this, there can be a deviation in the real asset price and the synthetic asset price. Now, let us take some time to understand tokenization. To understand tokenization, we need to first understand tokens. What is a token? A token is a type of programmable asset. Tokens can act as currencies, but can do much more. They can be used to represent voting rights, as in the case of DeFi protocols, or can be used to reward people for browsing web, as in the case of basic attention token, or track the price of an artwork, as in the case of non-fungible tokens or NFTs. Now, tokens are created and value is assigned to the tokens using smart contracts. Smart contracts for tokens are written using token standards such as ERC20 or ERC721. There are two kinds of tokens: utility tokens and security or asset tokens. Utility tokens are designed to allow users avail some utility on the blockchain network and are not investment vehicles, as they do not pass the Howey test. Security tokens are used as value reserves similar to traditional securities. Now, we are dealing with security or asset tokens here. Tokenization is a process of creating tokens which can closely follow value of other assets. For tokens to follow the price of an asset, the blockchain networks need to know the current price of the asset. This is where Oracle feeds come into play. An Oracle feed is a data link between a blockchain and the off-chain data source. There are two types of asset tokenization process: asset-backed tokens and synthetic tokens. Asset-backed tokens are backed one-to-one by the physical or abstract good they represent. For instance, an asset-backed gold token representing 1 ounce of gold would need to be backed by 1 ounce of physical gold. Synthetic tokens provide synthetic exposure to the physical or abstract good that they represent without requiring one-to-one backing. For instance, a synthetic gold token representing 1 ounce of gold would be exchangeable for the price of 1 ounce of physical gold without actually being backed by physical gold. Synthetic tokens can be issued either by a centralized party or a decentralized network whose incentives guarantee that the synthetic token is always exchangeable for the price of the asset it represents. Now that we have some idea about tokenization, let us get back to talking about gaining exposure to stocks through tokenization. One such platform that enables users to get exposure to various assets, including stocks, through tokens is the Mirror protocol. Mirror protocol is a decentralized system built on the Terra blockchain, but also enables trading of tokens on Ethereum and Binance Smart Chain. Mirror deals with synthetic tokens and currently has tokens tracking Apple stocks, Amazon stocks, Netflix stocks, Square, Robinhood, VIX, ETF, etc. Apart from this, there are Mirror tokens for Bitcoin, Ether, and Polkadot. Mirror is a DeFi protocol powered by smart contracts on the Terra network that enables the creation of synthetic assets called mirrored assets or M-assets. M-assets mimic the price behavior of real-world assets and give anyone in the world open access to price exposure without the burdens of owning or transacting real assets. I would recommend you to please watch my video on Terra network and Luna tokens to have better idea about the Terra network. Now coming back to this video, some features of the mirrored platform. First, the mirrored assets or M-assets are synthetic tokens. That is, they are not backed by the assets they represent. These tokens are minted using a collateralized debt obligation process with various cryptoassets as collaterals. There is no need for KYC to trade mirrored assets. M-assets or mirrored assets are traded through interacting with the liquidity pools on Terra Shop. As mirrored assets only mirror the price of real assets, and ownership of mirrored assets do not signify ownership of the real assets, mirrored assets do not give dividend. Now, there can be many ways to talk about the mirror platform. Let us talk about the different tokens used on the mirror platform and how they help the platform work. There are 4 types of tokens on the Mirror network: mirrored assets or M assets, mirror token or MIR token, and 2 types of staking tokens, LP tokens and SLP tokens. Let us start with mirrored asset tokens or M assets tokens. M asset tokens are the tokens which are blockchain tokens that behave like mirror versions of real-world assets by reflecting the exchange prices on chain. They give traders the price exposure of the real assets while enabling fractional ownership, open access, and censorship resistance as any other cryptocurrency. The M assets nomenclature means that if the asset is based on AAPL shares, that is Apple shares, the M asset is termed as MAAPL. The on-chain price of an M asset token changes through an oracle feeder assigned to the token. Before we talk more, let me clarify something. M assets are swapped pegged to the oracle price, which means that the Mirror protocol does not directly rely on oracle price to determine the trading price of the M assets. Instead, Mirror relies on a combination of minting liquidation process, arbitrageurs, and governance changes to keep the M asset prices closer to the oracle prices. The difference between the M asset price on TerraSwap and the oracle price is represented as premium. There are 3 basic operations of M assets: minting, burning, and trade. Anyone can mint an M asset by locking up collateral, either in the form of a stablecoin or a different M asset. The required collateral is at least a minimum multiple of the asset's value, 150% for stablecoin collateral and 200% for M asset collateral. To burn an M asset, the issuer must burn the amount initially issued to receive the locked stablecoin collateral back. Now, M assets are tradable on automated market makers on public blockchains such as Terra and Ethereum. It makes it easy for issuers as well as for the investors to buy and sell the M assets. One feature introduced with version 2 of the Mirror protocol is pre-IPO M assets. When an IPO is scheduled and price quote has been announced, a new M asset can be whitelisted as a pre-IPO M asset to be minted and traded on Mirror protocol upon passing a governance poll. Now let us talk about Mirror or MIR tokens. The Mirror token is the governance token of the Mirror protocol and is required to create a new poll or vote on active polls. As of 12th December 2021, the Mirror token has a market value of $193 million US. Now let us talk about staking and staking tokens. Let us start with staking. As the Mirror protocol is decentralized, it needs an automated market maker for price discovery and liquidity management. In case of Mirror, the M assets and Mirror tokens are traded on the TerraSwap platform. TerraSwap is a Uniswap-inspired automated market maker protocol implemented with smart contracts on the Terra blockchain. Mirror relies on TerraSwap to establish Terra USD trading pairs for M assets and mirror tokens. This enables a decentralized on-chain exchange for the various assets involved in the mirror protocol. TerraSwap creates automated markets for pairs of tokens. These markets are called pools, which enables users to exchange one asset for the other directly on-chain. Pools maintain balances of both assets to which users can provide liquidity in exchange for reward-bearing LP tokens. Now, to create the liquidity pools for automated market making, the yield farmers need to be incentivized. In order to compensate liquidity providers, TerraSwap charges an LP commission on each trade. The fee returns to the pool to serve as a reward for LP token holders and can only be withdrawn by burning LP tokens and reclaiming a portion of the pool. In Mirror, each liquidity pool for M assets and Mirror tokens has a fixed LP commission fee of 0.3%. This fee is levied on the trader and is received as M assets or Mirror or UST, depending on the direction of the trade. Now, coming to LP and SLP tokens. LP tokens are given to liquidity providers when they add liquidity to the liquidity pools. Each pool has unique LP token associated with it and cannot be combined with LP tokens from other pools. The LP tokens serve primarily as a unit of account, representing the liquidity provider's share in the pool in order to reclaim assets when they remove liquidity. Holders of LP tokens receive a portion of rewards generated by the pool's trading fees. Now, coming to SLP or short tokens. Before we talk about short or SLP tokens, let us talk about short minting. The Mirror protocol allows to take a short position on the mirrored assets, that is M assets. This is done to avoid the M asset price deviating too much from the oracle price. When opening a short mint position, an amount of collateral is provided in order to mint the M asset. During this process, an additional untradable token is minted. This is the short LP token or SLP token. The SLP token can be staked to receive a portion of the mirror that is allocated to the given M asset UST LP pool. As soon as the M asset is minted, the asset is automatically sold to TerraSwap. The Terra USD, that is UST, received from this automatic sell-off is locked for a governance voted period before being claimable by the user. Note that SLP cannot be transferred or traded, and they are immediately staked after being minted and burnt immediately after a position is closed. So let us summarize the Mirror protocol. The Mirror protocol is a decentralized protocol which enables creation of synthetic tokens called mirrored assets or M assets. These M assets track price of base assets using oracle feeds and market dynamics in the trading pools. The Mirror protocol has 4 types of tokens: the mirrored assets or M assets, the mirror tokens, liquidity pool LP tokens, and short liquidity pool SLP tokens. Mirrored assets are the synthetic assets. Mirror tokens are the native and governance tokens of the Mirror protocol. LP and SLP tokens are used to manage the liquidity pools for Mirror assets in the TerraSwap automated market maker. As mentioned before, yes, synthetic assets or tokenized assets are not 100% alternative to holding real assets, but they can help small investors get exposure to high growth asset classes and high growth economies like never before. Obviously, they have to be aware of the risks and limitations of synthetic assets. With this is Sam Ghosh. Thank you very much for watching. Bye-bye.